What if I told you that the richest people in America pay less tax than you? Not a little less. Not marginally less. In some cases, literally zero. And before you call it a loophole. Before you call it corruption. Before you assume it requires a team of expensive lawyers and offshore accounts in the Cayman Islands, I need to tell you something that is going to make this much more disturbing. It is completely, entirely, 100% legal. The tax code was not broken into by the wealthy. It was written for them. And the most infuriating part of this entire story is that the rules they use are available to anyone. They are sitting in plain sight in the same tax code that takes 30% of your paycheck before you ever see it. You just were never taught to read it. There are two tax systems operating simultaneously. Most people only know about one of them. The first system is the one you live in. Income tax. The system designed for people who trade their time for money. Every dollar you earn from a salary, a wage, a bonus, it is taxed immediately, automatically, before it reaches your account. You have no choice, no delay, no negotiation. The government takes its share first. You receive what remains. The rates in this system climb as you earn more. And that is before state taxes, payroll taxes, and social security contributions that can push your effective rate above 45%. The second system is the one the wealthy live in. Capital gains tax. The system designed for people who make money from owning things rather than doing things. Sell a stock you held for more than a year, 15%. Sometimes zero if your income is structured correctly. Collect rental income from a property, reduced by depreciation deductions that can eliminate the tax entirely. Borrow against your assets instead of selling them, no tax at all, because borrowing is not income. Same country. Same roads. Same everything. Two completely different sets of rules. This is the strategy that nobody teaches in school. It has a name. Financial planners call it buy borrow die. Here is how it works. You buy assets. Stocks, real estate, businesses, anything that appreciates in value over time. You hold them. You do not sell them. Because the moment you sell, you trigger a taxable event. The gain becomes income, and income gets taxed. Instead, you borrow against those assets. Banks will lend you money using your stock portfolio or property as collateral. You live on the borrowed money. You spend it, invest it, use it for anything you want. And borrowed money is not income. It is debt. It is never taxed. Meanwhile, your assets continue to grow. The loan balance stays fixed. The gap between what you owe and what you own expands every year in your favor. Then you die. When assets are passed to heirs at death, they receive what is called a stepped-up basis. The original purchase price is reset to the current market value. The decades of accumulated gains are permanently erased from the tax record. Your heirs inherit the full value, and the capital gains tax simply disappears. Buy. Borrow. Die. Zero tax paid at any stage. Real estate investors have an additional weapon called depreciation. When you buy a building, the government allows you to assume that the structure is gradually wearing out over time. Each year, you are allowed to deduct a portion of the building's value from your taxable income as if it is losing value, even when the market value of the property is actually rising. A $1 million apartment building generates approximately $36,000 in depreciation deductions every single year. If that property generates $40,000 in rental income, the depreciation deduction reduces the taxable income to just $4,000. The investor collected $40,000 in cash. They paid tax on $4,000. And the property was actually appreciating in the real market. This is not a gray area. This is the written, intended, designed function of the tax code. The third tool is the corporation. Specifically the way that business owners use corporate structures to pay for their lives with pre-tax dollars. When you earn a salary, you are taxed first and then you spend what remains. When you own a business, you spend first and then you are taxed on what remains. That single reversal is worth hundreds of thousands of dollars over a lifetime. A business owner can run their car, their phone, their home office, their travel, their meals, their professional development, their health insurance, all through the business as legitimate expenses. These costs are deducted before the profit is calculated, before the tax is assessed. A salary worker pays for all of those same things with money that was already taxed. Every dollar they spend on a car or a phone was taxed at 30 or 40% before it ever reached their wallet. The wealthy do not earn income and then spend it. They structure their lives so that spending and earning happen on the same side of the tax calculation. Even charitable foundations are used as efficient tax management structures. When a billionaire donates appreciated stock to their own foundation, they receive a deduction for the full market value without ever paying capital gains tax. The foundation, which they control, pays no taxes because it is a non-profit. And the assets inside continue to grow, shielded entirely from taxation. They got the deduction. They avoided the capital gains. They maintained control. Here is what you can actually do. You do not need to be a billionaire to begin using a different set of tax rules. You need to begin the transition from someone who earns income to someone who also owns things. Step 1. Start investing in index funds inside tax-advantaged accounts where gains grow tax-free. This is the most accessible version of the capital gains advantage. Step 2. If you have any side income, structure it properly. A registered business entity allows you to deduct legitimate expenses before calculating profit. You begin spending pre-tax dollars. Step 3. Educate yourself on real estate depreciation. Even small residential properties generate paper losses that can offset real income. You will not eliminate your tax bill overnight. But every step you take toward owning assets is a step away from the system designed to extract maximum value from you. The wealthy do not cheat the tax system. They use it exactly as it was written. You were handed a salary and told to be grateful. The tax was taken before you could think about it. The rules that would have helped you were never mentioned in school. You know now. The question is what you do with that knowledge. Drop a yes in the comments if you have ever looked at your payslip and felt sick at how much was taken. Because that feeling is not ingratitude. That is the correct response to a system that was never designed in your favor. Subscribe right now, because next week I will show you the exact first steps ordinary salary workers are taking to legally reduce what they pay.